I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim, right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today's video is going to be on the update of the leaked FDIC video that's been going around viral on various social media platforms. And where we're going to start the video is by actually finding out the exact origin of the original video, and then we're going to go into who is the FDIC exactly, what is their job, and why do they put together the Systematic Resolution Advisory Committee, and who are they? I'm also going to jump into some rumors that I've been hearing, and we're going to answer those rumors, such as, does the FDIC have 99 years to pay us back if we lose our money? We're also going to dig into more of the video so I can further point out some extremely disturbing things and some things that I believe are extremely important. Make no mistake, you guys, this is not a fear video. I believe that at the bare minimum, we need to be aware if we're going to properly protect our family, our finances, and investment. So this video is about awareness. What I can tell you guys right now is we are all in this together. And if you guys can, do me a favor, please, and like this video, subscribe if you haven't already, shoot me a comment below, and let me know what you guys think about this video. And another important thing we're going to cover is differences of bail-ins versus bail-outs, because that's really, really important to understand. And I'm also going to go into what is a non-banking institute, okay? Because there's so much going on right now in the world with crypto, with mortgage, and things like that. I really, really feel like understanding how our money is protected, how the FDIC works, is really, really important, especially moving forward into the future. The original origin of this video came from a subscriber, James. James, I love you, brother. Thank you for sending me that. That sent me an email with an article link that basically had a breakdown of this video. Let me show you where that email took me. So here's the original article that I reviewed, y'all. It was through News Wars. And if you scroll through here, they actually broke down several parts of the FDIC committee video, which is about 3 hours long, and it will be listed in this video. In fact, everything's going to be listed in this video, by the way, and you guys can find out for yourself, but the actual meeting was 3.5 hours long. And then this is all I was able to find. So I followed this link and I clicked watch on YouTube. And after that, it took me directly to this YouTube channel. So, you know, I'm already thinking like, what's going on here? Because this YouTube channel only has 68 subscribers. This is a fairly new video. So I'm like, oh my gosh, what's going on? But when I went to the description, I noticed that they had this link here. So I put the link in my URL, and this is what I found. 404 page not found. So after that, I eventually scoured their website, searched, used the search function and various things, and I found this, the FDIC webcast archive. So this is again going to be linked in my description. Now, the first thing that I noticed when I was here, I was like, where's the November meeting? Right? I started, honestly, when I first saw this, y'all, I started freaking out. I'm like, oh my gosh, they removed this. This is leaked. They're going to come after me. I'm not trying to fight the government, y'all. I have a family, right? I have goals. I don't want to fight the government, but I'm freaking out because where's the November video, right? So I start freaking out. I'm watching the December video. I'm watching the October video just to make sure I'm not missing anything. And then I finally realized, oh, there's this tab right here. Y'all see this tab? And then I noticed immediately that here's a tab for the Systematic Resolution Advisory Committee. I clicked that, and here's what I found. Actual video. So here's the actual video. Again, this will be linked in my description. The quality, y'all, is a lot better than the quality of the video I used on my first breakdown of this report. So I wanted to put in this video some basic fundamentals of the FDIC, our system in general, non-banks, bail-ins, bail-outs, and things of that nature, just in case you don't understand how the FDIC works and banking works. So what I want to point out now is let's take a look at the exact definition of who and what the FDIC is. Here's a brief article from Investorpedia. What is the Federal Deposit Insurance Corporation, or the FDIC? The Federal Deposit Insurance Corporation is an independent federal agency insuring deposits in U.S. banks and thrifts in the event of bank failure. Created in 1933 to maintain public confidence. That's important. Again, to maintain public confidence, which may be the most important thing of the FDIC, in my opinion. Let's go on. And encourage stability in the financial system through the promotion of sound banking practices. As of 2020, the FDIC insures deposits up to $250,000 per depositor, as long as the institution is a member firm. It is critical for consumers to confirm if their institution is FDIC insured. So in other words, the FDIC was created in 1933, not only to insure our money. So, one aspect is they insure our money in the event that the bank goes bankrupt, right? That they lose our money, that they do a bail-in. So they insure our money. But another huge component to the FDIC is public confidence, which is why all of their information is public, and which is also why they're sounding the alarm that, the public shouldn't know certain things, and basically that the public is made up of assumptions, and by telling the public the truth, it's really going to make things worse. So really, really shocking stuff, you guys. In other words, the FDIC is extremely important to our banking system and the confidence the public has in keeping their money insured and protected. Now let's take a look at why the FDIC created the Systematic Resolution Advisory Committee. The FDIC created the Systematic Resolution Advisory Committee in 2011. The committee serves as an advisory capacity and does not have final decision-making authority or access to any non-public confidential information on any organization. So in other words, the capacity of that committee is to advise and recommend certain policies and changes be made in order to properly protect the banking system and create public confidence in it, which is why it's so disturbing that some of the committee members, and we'll take a look at that here in a minute, start laughing at the public's perception and confidence in the banking system. So it's extremely disturbing, but where I want to take you guys into now is let's listen to some key parts of this video so that we can better understand why this committee even exists.
Vital importance to the FDIC. At the end of the day, our ability to manage the orderly failure of a systemic financial institution will probably be the ultimate credibility test for our agency.
So far I would agree with that their reputation depends on how well they do their job, since now we know that the FDIC's job is to insure our money and to maintain public confidence. But obviously their job is super important. Let's jump back in and listen to some more stuff.
For supervision and resolution responsibilities. I think one of the strengths of the FDIC is we have in one institution responsibility for resolution, a significant part of supervisory responsibility in the U.S. banking system, as well as the deposit insurance responsibility, communicating with financial markets as well as the public to try to establish better understanding of what we do. And that is really not a simple task, as you all probably understand better than most. So we want to talk about that issue. And then also what is a key priority for us, which is enhancing our ability to manage the failure of large banking organizations below the GSIB level. It's really a very distinct resolution challenge for us from the GSIBs, in many ways as great as the GSIB challenge. And because we were so obsessed with developing a capability to manage the failure of GSIBs, that was not the first thing we turned to was not the large banks. And then we woke up and realized the failure of one of these large banking institutions could really be an enormous challenge with financial stability implications. So we've devoted a lot of time. That's a priority, I think, for all three of the U.S. banking agencies, the Fed and the OCC, as well as the FDIC. And as you may know,
So one of the priorities of this meeting is essentially to identify that just one big banking institution can mess up the entire nation. If a Chase goes bankrupt, Wells Fargo, who just got out of mortgage lending, as far as correspondent, right? Bank of America, if these big institutions, just one of them fails and does a bail-in, it can doom our entire country. And that's really what this is saying. Now, their focus is also on other smaller banks and non-banks, which is really important to understand as well, because they recognize that they don't have a lot of control over like non-banks like mortgage lenders and crypto. Listen to this.
As Marty mentioned, obviously the failure of a domestic systemically important financial institution would be quite challenging. The FDIC has some good experiences, bad experiences, and learning from this. And I think it's no surprise that a CFPB director is worried about the failure of an institution with an enormous footprint in consumer and retail banking, a very large number of accounts, and the regional impact or national impact of its failure. And I think as he mentioned, there has been a proposal, an ANPR by the FDIC and the Fed about ways to prevent that and remove from the playbook of simply selling it to a GSIB. I'll also add, a couple of other points of concern for me. One is obviously the undesignated non-bank systemically important financial institutions. The Financial Stability Oversight Council has not designated any in quite some time. And I think many experts agree they exist, and we do not have resolution plans for them.
So this is FDIC acknowledging that there are some entities, non-bank specifically, that quite frankly, it's out of their control to prevent a financial collapse. So what I want to do is let's define non-banking institutions a little bit more clearly. What are non-bank financing companies? Non-bank financing companies, also known as non-bank financial institutions, are financial institutions that offer various banking services but do not have a banking license. Generally, these institutions are not allowed to take traditional demand deposits, readily available funds such as those in checking or savings accounts from the public. This limitation keeps them outside the scope of conventional oversight from federal and state financial regulators. And that's probably a big problem with all of this crypto nonsense. And I understand people want to conceal their transactions and have immediate money. But the fact of the matter is, if you do that, we have virtually no protection, as we learned from FTX collapse. Non-bank financial companies fall under the oversight of the Dodd-Frank Wall Street Reform and Consumer Protection Act. Examples of non-bank financial companies include investment banks, mortgage lenders, money market funds, insurance company, hedge funds, private equity funds, and PTP lenders.
As you know, following the 2008 financial crisis, Congress established new authorities for the FDIC to manage the orderly resolution of large, complex financial institutions whose failure could threaten U.S. financial stability, most notably Titles I and II of the Dodd-Frank Act. Shortly thereafter, in June 2011, then FDIC Chairman Sheila Bear convened the first meeting of this committee, noting that the knowledge and expertise brought to bear by members of the committee would greatly enhance the corporation's efforts to develop and implement these tools. In the 7 meetings held since then, a wide range of systemic resolution issues have been brought to the committee in order to test thinking and solicit your feedback. The first meetings obviously focused on core aspects of systemic resolution, including the establishment of the Orderly Liquidation Authority and the development of the foundational single point of entry strategy.
So those are a few purposes of the meeting. Again, you guys can go back and watch the whole 3 hours. I actually record the video and post it on my channel. But before I go into some additional disturbing things in this video, let's first analyze what's the difference between a bail-in and a bail-out. Because essentially a bail-in, we all lose, but a bail-out, we all take the hit together, so to speak, right? Because the government bails out the lenders, versus the actual depositors. Let's take a look at some definitions. So again, the bail-in is where the bank takes your money as a depositor to stay afloat, right? If they go bankrupt or something happens, any type of risk, a bail-in is where that bank takes your money. Let's read this. Bail-in clause history. During the 2008 global financial crisis, the U.S. government issued bailouts for a number of failing bankrupt financial institutions due to the substantial impact of their failure on the economy. So again, in 2008, the government bailed out many failing banks to basically protect depositors and to protect our system, right? So the bailouts were given, and the exception that the collapse of these companies would result in an overall economic disaster. The total cost of the bailout was estimated to be around $700 billion. And just real quick, guys, and the banks still kept the houses. The banks that survived, especially Wells Fargo, they get to keep the houses. So they got bailed out and they still kept the collateral, right? So we paid for their bailout and they still kept the collateral of the house. My house was one of those. It was largely funded by U.S. taxpayers, which caused political turmoil among taxpayers since their money was being used for purposes other than improvements in infrastructure and healthcare services. To avoid the issue, the concept of bail-ins was introduced, which pertains depositors and taxpayers at the expense of the creditor's debt claims. Bailouts versus bail-in clause. A bailout is the opposite of a bail-in clause and allows the borrowing organization to stay in business and to continue operations through the injunction of capital or funds by a financially stable institution or investor, or rather the government, right? On the contrary, a bail-in clause places more financial burden on the creditors, requiring them to reduce their debt so that the institution can survive and protect its depositors and the taxpayers. Therefore, bailouts expose taxpayers to more risk and financial burden, whereas bail-ins put the same pressure on creditors, especially on unsecured creditors, since they do not require any collateral before agreeing to the lending contract. Basically, what we know is when we put our money in the bank invests that money. So basically, guys, the bank doesn't have all of our money. If all of us decided to withdraw just 10% of all of the money in the US, would probably completely crash the financial sector and probably cause many banks and non-banks to have to protect themselves by doing bail-ins and taking everyone's money. So again, the bailouts are basically designed to prevent that from happening and to protect, the creditors and depositors at the expense of the taxpayers. Do y'all understand? So again, bailouts are way better, especially if you're a depositor, are much better than a bail-in. Look at FTX. I'm sure all of the people that had money in FTX wish there was a government bailout because they would have got their money back, right? But the thing is, guys, the government only has so much money they can print before things turn completely out of control, even more than they already are. Now let's go into some more disturbing things that I noticed in this video that I really want you guys to pay attention to and be aware of.
People need to know, but I don't think you have money. It should be accessible when people need to know, but I don't think you have much hope of reaching a public that doesn't have a professional need to know.
I completely agree with that. I almost think you'd scare the public if you put this out. Like, why are they telling me this? Should I be concerned about my bank? Like, my insurance company doesn't tell me what they're doing with my assets. They just assume they're going to pay my claim. Right? I think you've got to think of the unintended consequences of taking a public that has more full faith and confidence in the banking system than maybe people in this room do, that we want them to have full faith and confidence in the banking system. They know the FDIC insurance is there. They know it works. They put their money in, they're going to get their money out. So there's a select crowd of people that are in the institutional side. And if they want to understand this, they're going to find a way to understand this. There's a bunch of law firms represented in this room. There's a bunch of people that charge them by the hour a lot of money to explain this all to them, and it's fine. I don't have a problem with that. And they all have huge staffs. But I would be careful about the unintended consequences of starting to blast too much of this out and the general public.
So that's pretty brutal. They're essentially acknowledging that the public runs based on perception and based on assumption. And by us giving the public too much information, it would actually lead to additional consequences because the public, quite frankly, can't understand how it works. So that's what they're saying here, guys. So again, if one of their jobs is getting confidence from the public, and when you hear something like that, does that really give you confidence in the FDIC? But not only that, what I found remarkably remarkable, is they started laughing when they started talking about the public's confidence in banking. And the reality is, when I said we're all in this together, we are. If everyone starts pulling their money out, we all lose, right? So we don't want that. What we want is to diversify and to be aware so we can properly manage and protect ourselves. But again, you guys, I really, really am troubled by the laughing and the smirking on this man's face when he's going into the public assumption and perception in the banking system. Really, really shocking. And he's also warning the committee, he's warning the government, he's warning the FDIC to be careful about how much they give to the public. So again, you guys, I understand their points here. Let me know what you guys think. Should we suppress the truth, or is awareness the more important thing? Comment below. Let me know what you think. Let's jump back into the video.
I wondered whether there are some market tests of whether you're being heard. And I think about TLAC. So TLAC should respond to good and bad news about the institutions. And it's really important. I mean, it's a little bit conflicted, right? I mean, it's important that people understand they can be bailed in, but you don't want a huge run on the institution. But they're going to be. And it could be an early warning signal to the FDIC and the primary regulators when these things happen. And there may be some other prices, this is similar to what Jay was saying, in the market that you can tell whether people understand who's going to be protected, who isn't going to be protected. It would be, I think, an interesting study to look at the evolution of market prices in a situation like March of 2020, for example, and see whether people understood what might happen.
So they're saying that people need to understand that bail-ins can happen, and that if a financial institution that they're putting their money in, has any financial harm or gets in trouble, bankruptcy, anything of that nature, that their money can be taken from them, right? So they're warning that. But not only are they warning that, they're also saying that we can't warn of that because if too many people know about that, it will start a fear. And that fear will basically put too much pressure on the financial system as people take out their money, right? Freaking out, I got to go take my money. That fear will actually lead to financial collapse. So really, really crazy, right? I mean, think about, what do you do, right? I believe in the awareness, right? I believe in the awareness. If the public is going to freak out, tell them why they shouldn't. Explain to them that we're in this together. Explain to them these things in a way that they can understand, right? And in a way that we rebuild confidence in our banking system. And how does anyone have any confidence right now in our banking system or our government? And it's super sad because I want confidence in both. Let's finish out this video.
Back to some of Dick's early comments. I do think it is hard to get a lot of demand for transparency right now in this sort of period of peacetime, but that is going to flip, and it's going to flip probably even faster than we saw in 2008, where the need for communications really quickly in the social media world to avoid disinformation, to have some holding patterns for things like, I remember in the early days of bail-in, people saying they're coming for my deposits, right? So just holding communications that you can pull out that are helpful to deal with disinformation, some very simple things. And how quickly you'll be able to deal with different constituencies. For example, as liabilities are further up and closer to harm's way, when are you going to be able to give them some comfort, if any? How do you deal with foreign operations? How do you communicate to some of those different groups? I think ex-ante preparation for the speed of scaling up and the ability to get information out to avoid rumors taking over the narrative strikes me as probably the place that feels like it's got the most benefit in a world where I think you've done a pretty good job of getting out the basics of Title II and some of the basic resources that are available now.
When I hear this, to me, it's them acknowledging how fast fear itself, just the fear itself, can utterly collapse the financial institution, and also how important it is for them to stay ahead of that with how regular and how speedy and regularly available our information is. YouTube, the internet, right? So they're acknowledging that, but they're not giving us that yet, right? Where's the statement? Where's the confidence? To me, you guys, when I'm listening to this video and I'm really acknowledging it, their job is very important. I think they fell short on the confidence. When I watch this, they look worried, and they're basically telling me that I'm too stupid to understand things, and they need to tell me things in such a way, to hide some of the truths, or at least mislead some of the truths, so that I don't get concerned and pull my money out of the financial institution. I don't like that at all. It doesn't give me faith in what they're saying. It makes me feel like they know things that they're not going to tell us, quite frankly. And I personally believe that one of the things that we don't want to do is freak out, right? We want to be better managers of our money, make sure banks are a part of the FDIC. Probably don't do business with non-banks, right? Maybe not do business with crypto, various things of that nature, right? And another thing, you guys, I don't even know about credit unions. So I want to end this video on one thing. Let's take a look at a rumor that I've been hearing on whether or not the FDIC has 99 years to pay you back. Take a look. This is straight from the FDIC website. This will be linked in my description. It goes over 5 common misconceptions about FDIC insurance. So this goes over what they call real facts. Again, I encourage you guys, find out for yourself what they're saying, provide yourself with empowerment, with awareness, figure out what you do and what not want to do. But let me go to where the highlighted misconception is, and let's talk about that. The misconception is the FDIC can take up to 99 years to pay insured deposits when a bank fails. The facts. The FDIC occasionally receives calls from depositors about this myth. It often comes from consumers who attended a financial seminar and heard that the FDIC can and will take up to 99 years to pay the depositors' insured deposits after a bank is closed. This claim is false and entirely without merit. The truth is, federal law requires the FDIC to pay deposit insurance as soon as possible for insured deposits. Those within the deposit insurance limits. The FDIC almost always pays insured depositors within a few business days of closing, usually the next business day. Payment is made either by providing each depositor a new account at another insured institution or by issuing a check to each depositor. The limited exceptions that may take longer to process primarily are deposits that both exceed $250,000 and are linked to trust documents and accounts established by a third-party broker on behalf of other individuals. The delay, if any, for a depositor to receive a payment for insured funds is a function of the time it takes for the depositor or their broker to provide missing supplemental information that is needed for the FDIC to continue the insurance determination. So in other words, it seems misfounded, right? It seems according to the FDIC, and you guys comment below. Let me know if you've heard different stories. Let me know if you have sources of information so we can grow and learn together. But according to the FDIC, it's completely unfounded. Let me know what you think. So in conclusion, I'm more worried about non-banks like cryptocurrency, mortgage lenders, and companies like that ruining our financial institution versus big companies. I believe the big banks, Wells Fargo, Chase, BofA, I think they're going to be protected by the taxpayers and by bailouts, right? So I feel like, honestly, you guys, I don't know. Again, comment below, but I feel like my money is probably safest in some of these bigger institutions. Now, I'll also say this. I don't like the fact that when I put my hard-earned money in a bank, that they take that money and invest it, and that there are certain situations to where they don't have my money and I can't get it back right away. So I don't like that at all, you guys, but it is what it is. The question I'm asking myself is my money safe? And I believe the reality of that answer is there is nothing that is 100% safe. And that is the reality. There is no 100% guarantee. So to me, the next thing is the levels of risk. And I believe the bigger the bank, generally the less the risk. But again, you guys, let me know what you think. It's all about risk to me. I hope this video helped. I don't want it to scare you, but I definitely want you guys to be aware of how these things work. Now, other than that, I really hope you guys got some value, insights, and perspective. And if you're out there investing in real estate or banking, if you're in banking, I wish you luck and I hope you win.